Hello all, I'm Santosh Rao, MD and Head of Telecoms for the Americas. Very pleased to co-moderate this panel along with Guillaume. Just a little bit of backdrop, digital infrastructure is a sector that not only continues to witness tremendous capital formation due to strong secular tailwinds such as cloud migration and mobile data consumption, things you may have heard of, but has been an area that continues to see ongoing evolution of both the underlying business models and capital structures across multiple products. We at Natixis have been active across all these products, be it infra finance, ABS, real estate finance, term loan A, term loan B type structures to support business models across all digital infra subsectors, data centers, towers, and fiber. So we're glad that digital infra was chosen as a sector at this debt forum to discuss these underlying trends and unique attributes that make the sector a very interesting private and public debt story. We could not have chosen a better panel to discuss this topic. It is my pleasure to welcome a distinguished panel of executives at some of the most active, I would say, digital infra-focused firms globally. We have with us today Chris Moon, Managing Director at Digital Bridge Credit, with the responsibility for origination in the Americas and European regions, and a member of the Digital Bridge Credit Investment Committee. Welcome, Chris. We also have Elko, who is the VP of Corporate Finance at EdgeConneX, which is, I would say, one of the most active data center operators globally. We also have Oliver Bradley, who is the Managing Director of Digital Infrastructure Investing at Macquarie Capital. Again, one of the most active digital infra funds globally. And Thibault Savage, who is a Director in the Infrastructure Debt Team at CDPQ. Again, CDPQ is one of the most active investment firms out there within our space. Welcome again, Chris, Elko, Oliver, and Thibault. A plan, I would say, for this session is to spend some time talking about the sectorial backdrop, and then touch on some of the investment considerations and observations around the capital structure. And we'll have some time towards the end of the session, and we'll open this up for some Q&A. With that, why don't we begin with the sectorial backdrop? I'll give each one of you an opportunity to talk about your perspectives on some of the key demand drivers within the sector and how some of these demand drivers have evolved over the last few years. Your near-term and long-term outlook with respect to some of these drivers. I don't know who wants to start first. Oliver, do you want to take this question?
Yeah, sure. So, everyone has said I head up digital infrastructure investing for Macquarie Capital. I'm on the principal investment arm of Macquarie, so not part of the asset management business, Mira, which is the fund management business. We invest Macquarie's own balance sheet as equity, as sponsor into deals, and that's a big strategy for Macquarie. It's kind of a unique feature of Macquarie Capital, I think, that principal investment capabilities. And digital is indeed one of our key focuses and pillars. It's the last. I started focusing on fibre in particular in probably 2015 when I spent some time working for the British government. And when I was there, one of the things I was responsible for as we were trying to think about how to get more fibre in the UK was I was responsible for something called the Digital Infrastructure Investment Fund. So back in 2015 or 2016, we felt that one of the problems with the industry was we couldn't attract infrastructure investors to invest in fibre. It was the domain where institutions had invested. It was the domain of private equity, and that was a problem because the return profile of fibre didn't support it. And it just feels crazy looking back. It wasn't that long ago. We launched the fund in 2017, but we launched it because we felt an intervention by the government was needed to encourage infrastructure investors to invest in the space. As we roll forward to today. The problem the industry is facing is not one of a shortage of equity capital. So the biggest challenge that that I have is deploying capital, frankly, in a sensible way. And I think part of what we're trying to do is take businesses on a risk journey, on a de-risking. That's part of our strategy, is distinct from other bits of Macquarie. We're trying to take businesses that we can see are on a path to being proper core infrastructure, but may need some help to get there through growing or capital. Or that's generally what we do. And one of the challenges is finding opportunities where that de-risking that the company needs to go on isn't already being priced in, and people who are sort of assuming the best in their discount rates at the future. So I think so we've seen over the last 12 months in particular a real topping out of valuations, really quite low cost of capital going in for a given risk profile. I think where you're seeing it more is more on the business plans that equity is prepared to underwrite, and there's just so much equity, and people are prepared to. I think I worry that people have underestimated some of the execution challenges in some of those business plans. So that's one of the sort of things where I'm not quite sure if that was the question you were answering, but it's the question I answered. So,
that's fine. Thanks, Oliver. Maybe Elko, do you have anything to add on the demand drivers, particularly for EdgeConneX related to data centers?
Yeah, definitely. EdgeConneX is a data center developer and operator. Our main clients are content providers, the big cloud companies, tech companies like Facebook. EdgeConneX started in 2012 to kind of come up with a resolution for the spinning wheel when people were starting to use content more and more on their mobile phones, etc., bringing content closer to the end user. And around that time, the cloud companies realized that also they needed to put their workloads closer to their clients, being the enterprises. And actually, that trend is still there and growing massively. I think the pandemic has shown that at data centers and having data centers in close proximity to its users is critical infrastructure nowadays. So what we see is that our clients are continuously focused on building as much capacity as they can in a shortest amount of time, and they're doing that themselves, but they're also buying capacity with operators like EdgeConneX. We see a lot of support in terms of funding. There's a lot of capital out there. For us, the challenge is much more in finding the right locations. Our data centers are very location sensitive. Again, we need to position them close to where our customers want them to be. We are always building for customers. We are not building them and then look for customers. But I think it's a common theme across the globe that power is scarce, especially access to power. So for us, it's very important to be ahead of the curve, also make investments, for starting investments in land and power. And that's where we have our dialogue with our partners in terms of funding. How do we kind of use the structures that we have developed in infrastructure to support the full life cycle of our business. But again, the trends are only going one way, and that is building as much infrastructure as we can.
Yeah, thank you for that. And Chris, I don't know if you can hear us, but otherwise I'll turn it over to you as well. On the specific drivers you mentioned in case of EdgeConneX, looking at contracted capacity primarily, but can you talk a little bit about the evolution of the demand and leading to changes in business models across data centers, but the digital infra in general, with prevalent merchant risk and shorter term contracts and these impacting the way creditors and equities looking at the business?
Sure. Was
Chris,
that question? That question was
fantastic. Okay, so I'll turn it over to you, Chris. Thank you.
Yeah. Hey, everybody. So, look, from a credit perspective, this is a really interesting time to be investing. You've got very few organizations that focus very specifically on digital infra, by itself. So what we've seen in, throughout history, whether it's, coming out of the financial crisis, other pullbacks that we've had, that short time we had in March and April of 2020. In all of those cases, sort of the tide goes out just generally on capital, and we're starting to see that, in the syndicated loan markets. We're starting to see that, in the equity markets. And so, from our perspective, the private credit platform that we've been building here is really focused on, standing with those long-term assets while the capital tide, can be a little bit volatile. And it certainly feels like, the period that we're heading into right now, measures up to that. I think, where we play and, where we focus a lot is very similar to what Oliver described. We spend a lot of time on businesses that are, operating intensive, that haven't quite yet got to that core, to core plus type return profile. And, that's where a lot of our operating and diligence expertise comes into play. So, I think it's a perfect time, quite honestly, for the product that we've built, in the sense that demand drivers are all, flashing green. I mean, through the pandemic, a lot of these trends have been pulled forward dramatically. I mean, there's been a lot of, articles, research reports, everyone's talked about and thrown stats around about how prevalent the acceleration of digital infrastructure has been through the pandemic. And it's a really exciting time to be investing in it at a time when, the capital markets are starting to become a little bit dislocated. And, frankly, we see that, continuing for some time. So for us, demand drivers great, capital availability is starting to get a little bit choppy, and now it's about picking the winners and losers, which is what we're really good at.
And on that, Chris or Oliver, just looking ahead a little bit, when you think about the traditional digital infrastructure business models, i.e. data centers, towers, or fiber, given the ongoing sort of some of these key drivers and trends resulting in convergence and densification, further densification of the network, etc. I mean, we continue to hear themes such as edge computing and some of the 5G related business models, etc. So what's your view on some of these, I would say, newer trends and the impact that they may have on some of the underlying traditional digital infra models? How do you see that playing out over the next several years?
Well, I mean, I think it's going to take a little, some time to play out. We've seen some early success in those that have been, forward thinking around edge, but it's, the scale is still not, that of which you can really build a standalone business around or separately finance. I mean, for the most part, so we've seen a lot of, green shoots there, but we haven't really seen, standalone, of scale business models there that, are hard to, are something you'd want to get behind. So I think, what we have seen is a number of partnerships or those that are going out and creating this type of a product around existing infrastructure, which presents a lot of its own challenges, because the existing infrastructure that you're typically going to build edge around is got a lot of legacy telecom issues around it, and so that's something that requires having to parse through and and take on. So it's very, very operating intensive. It's definitely not something that you would think about in terms of core infrastructure at this stage. And there's a lot of hand-holding that is involved with that. What I do think, though, is there's probably a lot of capacity that's being used, and it's hard to say this in this environment right now, because every data center business that I talk to is really finding that the demand profile is off the chart. I mean, it's as good as it's been in most markets for a very long time, right? Yep. But I do think, as you know, there are workloads that belong at the edge that are, you know, housed right now in facilities that are getting them as close as they can, but not where they ultimately want to be. And I think you've got a number of those fringe facilities that are benefiting tremendously from the lack of development of the edge. And once the edge is fully viable, that, you know, they probably become, you know, somewhat obsolete. It's hard to see that today, but I think that's ultimately, from a directional standpoint, there will be losers in lower quality facilities that don't sit at the core or the edge, that have, you know, not maintained their level of capital spend, that have, you know, not maintained a good sales force, that have not, you know, been good to their customers, and, you know, and ultimately, you know, we'll see that play out in, you know, in the form of, you know, further distress with some of those businesses.
Yeah, and very quickly, Elko, since you with EdgeConneX, you're in a unique position from an operator's perspective, given that you do have your cloud business and also the edge business in North America. Do you see any sort of convergence there in terms of your client base and customer base coming to you with solutions that involve both the cloud product and the edge product?
Yeah, I think, and in the end, I think the customer kind of also determines what the edge is. I think there are different definitions for edge. If you look at the cloud business, as mentioned, we now see that customers are moving from the tier 1 markets, like Frankfurt, Amsterdam, into the tier 2 markets, which is a trend of also the cloud providers moving closer to their customers and putting their workloads closer to the enterprise, moving into smaller markets. In the US, we have a larger portfolio with smaller data centers. In Europe, for now, we see a trend that's very much still focused on the cloud companies who are driving our pipeline. And we're following closely where that trend is going and where our customers need us to build infrastructure.
I think just from my perspective, I think it is hard. Edge has been one of those trends, as you say, that's been a wave that's been about to break for a number of years now, and it's a bit unsure. One of the challenges is what's going to be the revenue model, particularly as you go very, I don't know what you call it, super edge or with the small cells. How you get the scale up. The mobile operators have been struggling for revenue models to support sort of small cell 5G deployment and that sort of thing. But I think from my perspective and where we sit now, I think the key is when we're sort of investing in infrastructure and fiber infrastructure in particular, you've got to be thinking about making sure it's being designed for all these potential optionalities. And I think we talk about fiber to the home, but reality, that's not what we should be about building. We should be about building fiber sort of everywhere. I also worked at Facility Fiber for a little bit. We would talk about gigabit cities and the concept of that you have fiber down every street and you're trying to connect everything. You're trying to have a network design that can connect everything, even though there isn't quite the business case for some of those connections at this point. But you want to only put that fiber in the ground once because it's an expensive thing to put in the ground. So that's a big part of what we're trying to sort of thinking, because I think inevitably convergence between particularly mobile and fixed, we're also already convergent in a number of European markets in terms of how it's sold, particularly in Spain, for example, but it's still not fully convergent in terms of how the network operated. And I think that's going to be kind of one of the interesting drivers as well, of the fact of seamlessly moving from your home to the street or from your place of work to the street, and seamlessly moving from your fixed connection to your mobile connection with the network working as one in those respects. It's those sorts of technologies I think are going to be quite interesting as well. But the key in the here and now is to be designing a future-proof network to try and allow for all these eventualities.
No, that's very interesting.
Absolutely.
We're designing infrastructure for many purposes, and we need to, in that sense, think about the next stage of development, which means that the business models that you're employing are not going to be as pure as they used to be. How does that work alongside very high valuation levels that we see for these core infra, which is not necessarily compatible with more risky, more volatile. Maybe, yeah.
I guess you're underwriting to a case that is, you know, that is sort of core, I suppose. So what's, you know, what justifies building the thing, and that's, you know, and so far the reason why fibre to the home has been an attractive market for us is actually it's quite easy to underwrite a long-term case there through supplying fibre to people's homes by doing it with ISPs, because we all need it. It's an essential service, and on you know, if you create a wholesale model in particular, you know, you're providing that service to ISPs, and you can that justifies the cost of building the network, and is a case you can underwrite. I think the key is to be designing your network to be able to capture some of these, what I would call upsides, which are hard things, you know, to underwrite. From an equity perspective, it's going to become quite important. We were talking ourselves this morning about, you know, the risks of inflation, and a lot of the contracts we're signing in wholesale for fibre to the home to justify building the thing, you know, are fixed price, or nominal fixed price. Is quite rare in most European markets, not unheard of, and increasing you are trying to do it, but to get indexation in your contracts. So, and that's okay, because the cost of the network is mostly upfront, and they're very high, you know, they're very high EBITDA margin, very low OPEX, so you haven't got big inflation exposure. But as we're thinking about valuations, we're going to have to be designing our networks to capture some of these additional services that we can offer, and additional upsides to enable our assets to increase in value appropriately over the medium to long term. So it's about capturing. You have a core case to underwrite, and then the potential for upside, you know, hopefully.
Right, and maybe turning over to you, Thibault, because we haven't had a chance to hear you. Maybe on before we move to the next phase, which will be about capital structures and how do we adapt to this. Maybe just curious to hear your perspective on how do creditors look at these adjacencies to the core business models, be it in fiber, as Oliver described, or in the data center space when you look at hyperscale models versus colo versus edge at some point. Maybe how does a creditor look at these different aspects and different volatilities?
So I think a bit similarly to the equity, the creditors open a bit the spectrum of transactions they are looking at. Clearly, also for a question of return, because core infrastructure assets usually they can get very attractive conditions. So in order to get a premium, we looked at what is core plus, what we call core plus, and other type of technology, like the one you mentioned, data center, fiber, telecom towers, and I think it's all a question of what capital structure you put on these assets. So of course there is quite some work of education before for the creditors. We need to get used to that, and there is always a lag compared to the equity, I would say, because we need to educate ourselves. But then clearly they have usually quite strong characteristics, and if we put the right capital structures on these assets, can be a solid credit as well. Now all these asset classes are different. I mean, data centers, for instance, an hyperscaler will be looked completely differently to co-location. Hyperscaler, I mean, if you have long-term contracts, 15-year contract, it's almost like project finance, and you can get very good conditions. Co-location requires more work, try to understand where it's located, what are the clients, is it greenfield, is it mature or still greenfield, what are the contracts. So you won't put the same leverage on a co-location, but we'll come to that in the capital structure part. And then fiber, I think it really depends on the market. You have France, which is a very developed market, where you can put some high leverage on the assets, because the regulation is very strong, and you have other markets which are a bit more wild, and where we will be more cautious as a lender.
Thank you. Maybe moving on more specifically to the capital structure, and we'll discuss that extensively in a second, but looking at valuation levels, equity return in the context of inflation, how do you approach that through direct protection against inflation in the contracts, as you mentioned, isn't always available? How do you think investors' perspective on what the inflation will be in the coming years, how does that impact valuation levels? Maybe Oliver, if you want to.
Well, I'm not sure it fully has yet. I think people are still sort of trying to sort of grapple with it and think through it. But yes, the key is what we're talking to. You know, we like to support our investments with long-term contracts, and so increasingly we're saying to people we're trying to buy stuff from or build fiber networks for, that we can give you more value if you if you'll give us some index linking. It depends a lot by market, and a lot of markets in Europe and the UK, telcos have been reasonably efficient at passing on inflation to their customers, and there's been quite a good track record of that. Now we've obviously been operating in a low inflationary environment, so it's hard to see if that continues. But so we do need to start thinking about indexation, I think, in our contracts. As I said, we're not going to get squeezed because the capex is mostly all up front, and ongoing costs are very low. So that it's not you're locking in a sort of a return profile at a given time, which is appropriate for the time that we're in, and it's not that we're not going to get squeezed by it. But then I think it is about thinking about, if you can't do it, ideally you do it for your contracts, and if you can't do it for your contracts, you've got to be thinking about, well, what other services can I do? How can I just grow the overall revenue of the business, in a way that keeps up with the economy in a real basis, which is what ultimately our investors are looking for.
And just one other quick question on valuation. I would love to get your thoughts, Oliver or Chris, just in terms of the rate sensitivity within the sector, right? I mean, there's a inflation aspect, but there's also rates that have moved up as a result of the backdrop, the macro backdrop here. And as you can see, I mean, like in the public market, it is a rate sensitive sector, right? I mean, there's been pullback in valuation levels, at least within the public comms. From your perspective, just on the private side, how do you see, purely from a valuation perspective, any major change in your views on the sector as a result of what's going on the public side, especially given the sudden movement in rates?
I mean, a lot of investors in digital infrastructure now will have a single-digit cost of capital on their equity, and inevitably, as the cost of debt is going up, then you feel it has to ultimately have an impact on the cost of equity. I'm not sure how quickly you'll see that flow through, though, because there is just most investments will have locked, most deals done in the last couple of years will have locked in their rates for at least another 3-4 years or whatever. You've also just got a load of capital that has been raised in the last 12 months, and that will have been raised for a given return profile. So I don't expect to see a very dramatic change. I mean, people will need to be thinking about it in terms of their terminal valuations and their exit valuations and testing the robustness. And we're already seeing that a bit internally on deals that we're looking at, saying, well, actually, can you run, I don't think that base case exit valuation is appropriate anymore. Can you run it on a let's assume a more conservative exit valuation or a terminal valuation? And I think that will start to sort of flow through. But it's, we are, the good thing about infrastructure is we are long-term investors and things don't change that quickly. It's not that volatile because there is, as I say, a lot of capital already out there. So I think it will take some time to go in. But I think inevitably, if we in a high inflation environment and it stays a high inflation environment and market discount rates increase, and that we will be sensitive to that from a valuation perspective, I think.
Well, that's interesting. It means that for the time being, so long as we haven't exhausted the current pool of liquidity, which is the dry powder, not yet in the sector will remain isolated to some extent from that. And then once that dry powder is exhausted, we'll see what inflation and rates environment we're in. Very interesting. Maybe turning to you, Thibault, on CDPQ being a value investor, you're present across equity, debt, public and private markets. Before we move to capital structures, just talking about ESG considerations, how does your institution look at telecom, and how do you see some of the environmental concerns around power consumption and carbon intensity of the electrons? Can you talk a little bit about how a sector and product agnostic institution like CDPQ looks at these aspects?
Yeah, no, sure. So I think there are very different assets. Fiber, for instance, power consumption is quite low. So especially the one that is deployed in a rural area, clearly the S of ESG is very strong. So we look at them with a very positive view. Same for telecom towers when it comes to densify a network and reach populations where are not as well covered before. It has also a very positive social impact. Now, I think where it's a bit more complicated is on data centers, where clearly there is a significant consumption issue. So, of course, we looked at where the power comes from. And of course, if it's electricity is produced with coal or petrol, it's more an issue. Now at CPQ, when we analyze an asset, we want to, the picture is not necessarily green the day we invest, but what we want to make sure is that over time, there will be a transition towards a greener asset. So if the sponsor has a clear plan of using more renewable energy, and it can be documented with covenants, this is something that we can consider. So actually, we have a specific basket at CDPQ for this type of assets that are kind of brownish today, but should be greener in the future.
And for these brownish assets, you then have a prescriptive view of what needs to be done. Is that a major factor in your investment decisions, or is that more of a nice to have and being aware of how these transitions take time?
This is a major factor in our investment decision. So we have an in-house ESG team at CDPQ with which we work closely, and we will work with this team to make sure that the path is well defined with KPIs and in order to get the transaction approved internally.
Great. Then maybe moving to capital structure. Santosh, we can't see you on the screen, but should I raise the first one, or? I know you're back.
I can. I'm happy to ask a couple of questions here. Interesting ones, actually. I think this is one of the reasons why we chose digital infrastructure as a sector at this debt forum, which is that increasingly the underlying capital structures, given the evolution of the underlying business models, etc., it's increasingly becoming hybrid in nature. It's very dynamic. It's becoming the hybrid is sort of the new normal. We see folks accessing many different financing structures and markets, whether that's infrastructure finance, real estate finance, ABS, term loan A, term loan B structures. Maybe we can start with you, Chris, for your thoughts on this hybrid structure being the new normal within digital infrastructure.
Yeah, sure. And frankly, this is really a lot of my career in this industry has really culminated around the development of that. And when we first started lending to the sector, everything was done in the leveraged finance market, and it was quite hard to find capital. And where we are today, which is a full evolution, the kind of tools you have at your disposal are you have the ABS market, which has been really, really accretive for a lot of investors. You have the real estate market, which we've seen in some very innovative financings like CyrusOne and QTS. You obviously have sort of this infrastructure approach where there's a lot of credit given to long-term contracts, book but not build type adjustments. And then obviously you still have the leveraged finance market, which is probably of all of those options, the one that's probably the highest cost and least efficient, but you can rate, but it's the deepest of all of those just mentioned. So I think that evolution has really become something very unique to digital infrastructure. The fact that one, it's a global business, and two, that it accesses so many different pockets of capital. When we think about approaching a new financing, it's kind of a starting at square one, looking at sort of the underlying assets, and then starting to test the depths of each of those alternatives. And a lot of times you're bringing one or two markets together, in a financing. And I think I mentioned CyrusOne, and that's probably one of the most creative financings we've seen in the last 12 months, where they're bringing together so many different elements of the market. Now it's very large, so you have to access depth in, in a lot of different pockets. But that to me is what's really been driving a lot of the growth. And as we started to think about the credit platform here at DigitalBridge, what was most exciting is, as we see everybody bringing, those different, pockets together, it's still telling, me that, the market could be much more efficient than it already is, and that we're still learning and we're still borrowing. We're borrowing concepts from oil and gas. We're borrowing concepts from traditional infrastructure. We're using old technology. We're using new technology. So, I think the industry is still trying to find, its natural, most efficient home in terms of what the right financing market is for it. So, very exciting.
Great. It's great. Anything you want to add to that, Thibault or Elko?
Yeah, I think I can echo what Chris is saying. We are also, I think, in each market looking at different opportunities. I do think there is a difference. The US market is not the same as Europe, and both are not the same as APAC. When I started doing my first deals in data centers, it's actually the project finance platform we developed at the time was at ABN AMRO for EdgeConneX. That was really still traditional project finance. I think we have developed that over the years, and today we're really using techniques from different types of financing. We call it hybrid. I call it, looking for funding sources which can offer the flexibility to us that we need to develop our data centers, where you also see that development process has become, maybe more dynamic. Our customers are also evolving in terms of how they contract their capacity. The pace has tremendously increased. The number of projects that we are developing simultaneously has tremendously increased, which makes it more challenging to do standalone project finance. So on the back of track record, the market has invested significantly in knowledge, the funding market. Obviously, we have a very solid business model for funders. We do wholesale. All our deployments are contracted, so that helps a lot. But we are really looking for flexibility and using all these techniques to create the flexibility and still offer a infrastructure profile to debt investors.
I agree with what was just said. I think, in Europe, the market I know best, I would say that the hybrid structure, corporate infrastructure structures are becoming the new norm. You still see some project finance type financing for assets where the regulation is very strong, like fiber in rural areas in France, or an hyperscaler with a very strong contract. But usually it's becoming more and more rare, and now we see these flexible structures. And I think creditors now are comfortable with the fact that there is a need from the borrowers for this flexibility, because it's a market that is growing quite fast. There is a lot of investment required, some acquisitions sometimes. So it's important for borrowers to have this flexibility in the financial documentation. In terms of cost, it's usually a bit more expensive to go into the corporate infrastructure type financing, but I think given the growth path and the business plan of the borrowers, it makes sense for them to pay a bit of a premium for this flexibility.
Great. And I guess if we have to talk about one aspect of the underlying, one aspect of the sector, and also one risk associated with the sector that folks typically focus on, I would say, given that the sector is typically, it's really strong counterparties, long-term contract, and that sort of defines the sector. The focus is on this thing, the renewal risk most often. Just would love to get your perspectives on how you, if we were to pick one risk associated with the sector, it's probably that's the one risk that everybody focuses on. I would love to get your perspectives on how you typically assess that risk, the renewal risk associated with various business models within the sector. I don't know, Chris, if you want to start with that from your perspective.
Yeah, sure. So I guess I might take a different view in that I actually think, some of the things that we've talked about related to inflation and what that means for interest rates is potentially the biggest risk for this sector. And I think, Oliver touched on it, but, persistent long-term inflation and associated, rise in interest costs will definitely be the first thing that starts to impact valuations and starts to really create, pain in a lot of the businesses that we look at. Renewal risk is something that, we all spend a lot of time focusing on, and it's, the way we underwrite and, the way we, think about these businesses long term, has always been, a risk in the backdrop. I think, if you look at the gamut of, sort of the most long term, if we just take the data center industry as an example, sort of the most long term risk that has been, typically associated with the hyperscale tenants, is something that we haven't really seen a lot of churn around. Now, in fairness, those contracts, typically have been, underwritten to on a fairly long-term basis. So, could we see, a bigger uptick in, in large churn events? I mean, the interesting thing with that is, when you do have a large churn event, it's very, impactful. So, but broadly, we really haven't, seen a lot of the hyperscale clients come back and present, a lot of material risk if they're happy in the facility, and it's a very well-run strategic location. I think where you still see a lot of churn and renewal risk is on the enterprise, colo side, and there's a number of platforms that are experiencing very high churn, related to customers, shifting in those businesses. But look, I think that's it's one of the underlying factors, of this business where, managing churn and having a sales team that can replace it, having good relationships with your customers, making sure that you're anticipating their needs and, sort of doing all of the things that, they require, within a facility, has been working, quite well, for the top operators. And again, there's probably only a small handful of examples where, that's not working well, but, obviously an area that, we all spend a lot of time thinking about.
Got it. Anyone else wants to add anything to
maybe
to that, the renewal risk?
Yeah. So
Go ahead, Thibault.
On the capital structure side, to capture this risk of recontracting renewal of the contracts, I think we'll go on shorter maturities, maybe 5 to 7 years, which are usually aligned with the length of the contracts that we see. Also, some features we want to see some deleveraging before maturity. It's important to factor this risk, so it can be through cash sweeps or through decreasing lockup and covenants. Another thing that we've seen more rare, but it's like a weighted average life of the contract covenant. So, for instance, the project goes in lockup, see if the contracts are becoming too short. This is something that we've seen on a few occasions. But yeah, that's some of the features that we could see to mitigate this emergent risk.
Got it. And sorry, go ahead.
Yeah, I was going to say that what we see is that we have the benefit of long-term contracts. I think our weighted average contract life is close to 10 years, but also typically when we have a customer in our campus, that customer has a tremendous demand for growth. So actually with each contract of additional capacity that we're adding, that strategic relationship with that customer actually grows with the tenor of that last contract. So also in that sense, the strategic nature of the deployments that the customer have in our facilities and the fact that they're always growing kind of gives an additional mitigate to all the contracts, which obviously at some point are somewhere in their lifetime. But the total relationship, the tenor of that keeps growing.
Got it. And very, Olive.
On the operational side, I think the key things that we need to focus on, and people always don't, is cost and time to build. If you're looking at greenfield things, I mean, things take longer to build than you think they will, and they tend to cost more than you think they will. And that obviously has then if you size your debt for that, and if you think about some of your ratios and things like that, that can become one of the sort of critical risks to manage, depending on obviously what the nature of the business is. And then in some markets, it's it's about how quickly you can all agree on where the end state for sort of penetration rates and stuff like that is, but how quickly can you move customers onto a fiber network? So on the demand side can vary as well, and can make things a bit tight in the early years.
Yeah, no, that makes sense. And very quickly on the geographical nuances as it relates to the underlying capital structure for the sector. Any thoughts around funding sources in various geographies? I know many of you have operations or investments across the globe. Would love to get your perspectives on some of the geographical nuances when it comes to funding sources.
I can give some experience there. I think, as mentioned, the big geographies do differ. I think Latin America is still much more a bank market, more traditional in terms of structures. Probably a bit where we were when I mentioned when we did our first project finance for EdgeConneX. Obviously, the US much better developed that capital markets product, which we don't see in Europe yet. Although in Europe we see a lot of institutional investors also being active in the space, but much more in participating in bank structures and or private placements, and not so much in the rated product yet. We are currently venturing out to APAC as well, which I think is much more a scattered market still, differences between jurisdictions, different lenders focused on different jurisdictions. Quite interesting.
Yeah.
And maybe a question for you, Thibaut, and Chris, possibly on private versus public debt. And obviously, private debt can have an ability to be tailored to certain situations. Maybe it's a matter of life cycle, but how do you arbitrage and how do you view these instruments as solving different problems at different stages for telecom infra? Maybe Thibaut, if you want to start.
Yeah, sure. So I think the telecom infra is a good example because it's growing at the moment with a lot of capex requirements, so it's quite difficult to access the public market on that basis. It's much easier to tap the bank market for that. The other thing is that in digital telecom, but digital infra, but also in the wider infrastructure sector, projects are usually mid-size, I would say, most of them. Of course, you have some jumbo transactions, but you have a lot of projects between 250 and 1 billion euros. And this is difficult. It's a lot of work for the management team to deal with the public issues. While clearly on the private side, they're helped by the banks, by the private investors to structure something that works best for them.
So it would be more a matter of life cycle than what you start with private debt and then you move on to the public markets once you've stabilized it.
Yeah, I tend to agree. I think once the market will be more mature, more consolidated with larger players, at that time it will probably make sense to have bond issues, because they will have the scale, the size. And,
Interesting. And Chris, you have anything to add on this specific point?
Yeah, I mean, I would also say, I think as the market evolves, the private markets may be, best for, the beginning phases, but they also might be best for the long core and core plus assets. And we've started to see that. And frankly, the disintermediation of the syndicated loan markets has really created a lot of value for, some of these long-term investors like, pension funds and insurance companies that, tend to be large consumers of product from the syndicated loan markets, and then, after obviously all the friction costs and fees and everything like that. So it's, I do think there's a path for those types of institutions that are flush with capital to go direct into these businesses and give something to the borrower that's, more valuable potentially than what they're getting from the syndicated loan market. What I see right now is, given sort of the disruption in the equity markets and, what that's meant for the syndicated loan markets, it's much harder to get underwritten financing than it had been, certainly 6 months ago. And what that also means is that, those sort of like those sort of buy-side institutions that are looking to hold long term, it creates opportunity for them to come in and, they think about these assets in a very long-term nature. They're not necessarily trying to, price it for, the last eighth of a point. And, and so to clear the market, if you can, kind of bring those two parties together, can be a really powerful, sort of really powerful dynamic in this environment. And I think we're going to see, much, much more of those sort of institutional debt investors going direct into these financings, certainly in a volatile public market like we see today.
Great, interesting. Maybe one last question for all of you around the current market environment. And we've seen over the past couple of years, equity valuations going up, liquidity flushed on credit side as well, allowing borrowers to get very good terms. And there were some must-haves to reflect the hybridation of business models, but there were also some nice-to-haves, I guess, in the structures. Do you feel like there will be some sort of rebalancing of the bargaining power between issuer and an investor in the current context? Or it's going to be one and the same for the longest time?
I think we are going to have mixed view here.
Maybe Thibaut, you can argue for no, but yeah, interesting to see your perspective on that bargaining power and rebalancing somehow between creditors and...
I mean, I agree that in the last couple of years, I would say, even the last 6 months, clearly the conditions have been loosening quite a lot. And already over the, I would say, the past few weeks, clearly I think there is more bargaining power on the terms from the lender side. I think that we're starting to see a change in power there. Now, is it going to last? I mean, if the public markets are still so volatile, I think it's probably going to last longer.
Thank you. Anybody else wants to chip in on this?
I think banks have already had it always been quite hard the last couple of years. So I don't know if I accept the premise of the question, but the.
Okay, well, I don't think we have time for Q&A, so I'd like to... Oh, we do? Okay, so I'll open the floor to one then.
Thanks. This is actually for you, Elko. So, we talked about it from the other side in terms of bargaining power from credit investors. But as we were hearing earlier, the financing of particularly of data centers has developed from two different directions. In the US, it came from sort of leverage finance side. In Europe, it came from the infrastructure finance, project finance side. You also have data centers being financed as real estate in the US. That's another way it's being done. And also in the ABS market, which is yet another way by which you have debt being put onto these types of assets. So the question to you is, what flexibility do you have in the current market as an issuer to arbitrage these different credit markets?
Yes, that flexibility is there. I mean, I think we have been active in all of these markets. I think also in some transactions we find ourselves with banks who are more real estate focused and banks who are more infrastructure focused, and that creates interesting discussions and also sometimes misunderstandings because of differences in reference point and also just structures they have been used to see. I think in the end the discussion always boils down to where's the cash flow coming from, and where are the contracts, how are your cash flows ramping up, what is the outlook, and I think if you look at these different markets, again I think jurisdiction is key there, and I think they all have their pros and their cons, and I think what's very good for a company like EdgeConneX is that we have the flexibility to tap into different pockets of liquidity, be it to either fund the business in a certain jurisdiction or raise capital that supports the business globally. But I think in all these markets you see that digital is, together with renewables, kind of the two flavors of the day, and everybody is investing in knowledge and experience and in capabilities to support these two. So yeah, so I think that the flexibility is there, and we're using it. Yeah.
Great. Well, I think we're done. Thank you very much to all of you for your participation. Oliver, Thibaut, Elko, and Chris on the line. Thank you on behalf of Santosh and myself. We're very happy to have this discussion, and I hope you enjoyed it. Thank you.
Thanks all.